Good evening, everyone. In a year of milestones, another one was hit on Wall Street today. For the first time since the year 2000, the Nasdaq Composite Index closed above 4,000. In the 13 years since, Nasdaq, probably more than any other market barometer, has swooped and swooned and struggled to regain its former heights. The Dow and the S&P 500, for example, hit fresh records back in 2007 and again multiple times this year. Not so the Nasdaq. After cresting at 5,048 in March of 2000, it all but crashed and spent much of the past decade plus at half its former high, if that. And even today, after a 33% gain this year, it is still 20% below its dot-com era peak. Nevertheless, today's milestone is just that, a marker on a market's road to recovery. And by many measures, today's Nasdaq at 4,000 is far, far healthier than Nasdaq 4,000 13 years ago. Let's take a look at today's historic numbers. The Dow sold off into the close, eking out a fractional gain, but enough for a fresh record close. It's fourth in a row and 43rd this year. The Nasdaq was up 23 points to finish at 4,017, and the S&P 500 was up a fraction of a point.
Joining us now to talk more about Nasdaq 4,000, Jim McCaughan. He's CEO at Principal Global Investors. Jim, welcome to the program. I understand that you agree with that statement that Tyler made a moment ago, that the Nasdaq 4,000 is much healthier today than it was 13 years ago. Tell us why and what metrics are you looking at?
Yeah, the difference, Susie, is that this time the market has been going up because of earnings, and the fundamentals for U.S. private sector remain very strong. And that's really what's driving the Nasdaq. It's on 24, 25 times earnings, which is pretty reasonable, actually, given the growth potential. Equities generally on about 17 times earnings are in line with the long-term average. At a time when the U.S. private sector is doing well and there's good momentum to profits, that's actually a pretty reasonable place to be.
So this time is different in your view. Last time was a bubble. But why hasn't, Jim, the Nasdaq risen past its former all-time highs the way the Dow and the S&P have?
Yeah, the difference, Tyler, is that the Dow and the S&P didn't run on fumes at the end of the last decade, or the end of the previous decade, 1999-2000. They didn't run totally into bubble territory like the Nasdaq did. Remember, it was that extraordinary internet bubble when prices did lose touch with reality and stocks were valued well away from earnings. The difference now is we're still in touch with fundamentals. You know, a bubble could happen, but it hasn't happened yet.
So how big an event is Nasdaq 4,000, especially since it's still 1,000 points away from its real record?
Yeah, I think it's a pretty big event because the real record, as you pointed out, was in 2000, and actually the record high was 99. The last time it was above 4,000 was in year 2000, so 13 years ago, more than that. So I think it's a pretty big deal. It's a good sign of the recovery of the U.S. economy, which is what those stocks really reflect.
As you look ahead, Jim, to 2014, what are you expecting for equities?
Yeah, I'm expecting another pretty good year for equities, Tyler. I base that optimism on really three factors. The first is the U.S. has got the cheapest energy in the world, particularly natural gas. Secondly, a tremendous record of innovation and technology. The world wants to buy the stuff that the U.S. does, whether it's in electronics or aviation or other technologies. And then thirdly, we have a housing market that appears to be fairly secure in a slow recovery. These factors are really driving company profitability. The fundamentals suggest to me that all the main equity indicators might rise as much as 10 to 20% next year.
So investors have gotten very used to these, market milestones, rallies. But is there any wild card that they should be bracing for that could happen in 2014 that could end this record run?
Yeah, there is, Susie, and there are a number of things I would watch for. The first is when the Fed taper happens, which I believe it will, most likely in the first quarter of next year, you will likely see some short-term volatility, maybe a 5% setback. The answer on that for equities will be to buy into the setback. Not true in bonds. Don't touch those because yields are going up. So that would be one event that might cause some instability to equities. Another thing to watch for is the 10-year Treasury yield. If the negative action in bonds turned into panic, and you got a 10-year Treasury yield currently 270 odd, if it moved up to 4%, that would be enough to choke the housing market and push the US back towards recession. I don't think it'll happen, but it's worth watching. And then lastly, you really just have to watch for any other kind of public policy error. You know, in a way, the strength of the equity market's been in spite of Washington,
Jim,
continues
I'm so
to be
sorry.
so.
You have such good thinking on all of this, but I'm afraid I'm going to have to interrupt this interesting conversation. But you've given us a lot to think about. Thank you so much for coming on the program.
Thank you, Susie. Thanks, Tyler.
Jim McColgan, CEO at Principal Global Investors.